Okay, welcome back everyone to our options education webinar series. Today we have a pretty special webinar talking about the market outlook.
Okay, welcome back everyone to our
what the current market conditions are. I have Michael Khouw with me, president of Optimize Advisors and host of CNBC's Options Action Show, to be here with me to talk through a few different things about what's currently going on with the market, what our outlook is looking into 2019. We'll talk about a few things regarding, how we're seeing option strategies play out in this particular market, how you can position yourself for the type of volatility that we're trying to see. I want to put a lot of things into perspective for people because I do see that there's a lot of noise out there. If you read the headlines, there does seem to be quite a bearish view to the market. So I want to put some of those things in perspective, get Michael's thoughts on that as well. And then we'll talk a little bit about risk management, because I think that's extremely important in this type of market condition, and based on the questions that we've been getting over the last few weeks, talking about proper risk management, how to go about doing that. So those are some of the things we're going to go over. And then what we're going to do is we're going to open this up for Q&A. A lot of you have already submitted your questions in advance. We're going to go through those questions first, and then we'll open this up for Q&A at the end. We're going to stay here for as long as we can to try to answer as many questions as possible. So today, a few things we're going to go over before, just a little bit of housekeeping. For those of you that are brand new to OptionsPlay, welcome. You can sign up for a free 30-day trial at OptionsPlay.com. We have a few important links in the slides that we'll be sending out after we're finished here with the recording. So please take a look at some of those slides. I might reference some of the previously recorded webinars as we go through some of the questions. So make sure that you take a look at the slides that we send you so you have the links to those educational webinars and those links. So with that, what I want to do is just, like I said, talk about current market outlook, what we're expecting for 2019, what type of option strategies that we think are suitable for the current market environment and what we're expecting to see. Lastly, talk a little bit about risk management, and then open this up for Q&A. And with me today, I have Michael Khouw, a very special guest. Thank you for being here with us, Michael.
It's my pleasure. Thank you very much for having me.
Hey, Michael, can you hear me?
I can hear you. Can you hear me? It's my pleasure. Thank you very much for having me.
Yeah, thanks. So thanks for being here today.
Hey, Michael, can you hear me?
I can hear you. Can you hear me?
Yeah.
It's my pleasure. Thank you very much for having me.
Yeah, thanks. So thanks for being here today.
Hey, Michael, can you hear me?
One second.
Sorry.
All right. So sorry about that. So Michael, if you don't mind, just do a quick introduction about who you are, what your experience is, what type of outlook you're bringing to what kind of perspective you're bringing to us, because I think it's really important for some of our traders here to look at, understand kind of what your background is and kind of what type of perspective you're going to be able to bring to the questions that we're going to ask you here today.
Sure, my pleasure. I began in the industry first as an options trader in the 1990s. I started on the floor of the Philadelphia Stock Exchange working for a proprietary trading firm called Gateway Partners. We specialized in volatility arbitrage, mostly single name volatility arbitrage. And then we began to focus on dispersion trading, which was trading the relationship between options on indices, ETFs, and the single names that were constituents of those indices. I was subsequently also a member of the American Stock Exchange, where I ran the specialist unit there, and also the New York Mercantile Exchange, because in a subsequent iteration of the prop trading group I was a part of, we were focusing also on the commodity space. We traded options on the energy complex, natural gas and oil. That was kind of a natural offshoot for me because I had spent a lot of time trading the oil service index stocks. From there, I went to work for a hedge fund called Ivory Capital. Ivory Capital is a Los Angeles-based deep dive fundamental long short hedge fund, managed about $5 billion at its peak. focused on deep dive fundamental analysis, kind of a private equity approach to public equity and debt investing. And I was recruited essentially out of there by some acquaintances of mine who were working at Cantor Fitzgerald. Cantor Fitzgerald, some of you may know that name, is a New York-based smaller investment bank and institutional broker. They wanted to get into the institutional option sales and trading business, and I was brought in and ultimately ended up running that. I became a partner of Cantor Fitzgerald, and I was there for about 6 years. And since that time, I've been focusing principally on financial technologies and how they can be brought to bear in the option space, and then using those technologies to advise institutional clients, such as pensions, endowments, insurance companies, hedge and mutual funds.
Well, thank you so much for that intro. And I really think that the perspective that you bring to us is quite interesting, because you've been on pretty much every side of the options trade. You've been a market maker, you've been on the buy side, you've been on the sell side. And I think we have a lot of great questions here today that you bring a perspective to that we usually don't get to see on the retail side. So let's just jump into it real quick. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. For those of you that don't know who I am, I'm going to just jump right into it, because the markets have been pretty crazy over the last few days, or last few weeks rather. And I think a lot of people are concerned as to where this market is headed. So I just want to start off by talking a little bit about the current market condition and putting some of the things into perspective, because if you read the headlines over the last few days, it sounds like the world's falling apart. But in reality, the market is down quite a bit. It's down about 13% from the peak, from October peak, which is actually not that uncommon. We've seen that comes with quite a bit of frequency, and a lot of times, on average, a pullback of this size does actually recover within 2 to 3 months. The only difference, I think, that this time around that may feel a little different from other people is the fact that this decline of 13% happened over only 2 months. Usually that average is about 4 months. So it certainly has happened a lot quicker and faster than what we typically see. And I think that's where a lot of the fear that we're seeing in the headlines is coming from. But from my perspective, I'm seeing these sell-offs on relatively low volume. And from my perspective, the fundamentals do not necessarily justify as severe of a sell-off. And I just wanted to understand kind of what your thoughts are as well on kind of the current market condition, given the extreme amount of volatility we've seen over the last few weeks.
Sure. It's interesting because if one only focused their attention, I think, on the U.S. equity markets, it would seem like the volatility is a relatively recent arrival. We've obviously been in a prolonged bull market in equities, and a prolonged bull market in bonds, and arguably a longer one, with obviously the credit crisis sort of stuffed in the middle on the credit side. But if you take a look at this year, it's pretty interesting, because the relative weakness recently in U.S. equities from a global perspective is actually a complete anomaly. The equity markets globally weakened. They reached their zenith in January of 2018. And they've been trading weaker ever since. And it is only in the United States where we had this big disconnect. We can try to sort through that and try to establish why that disconnect might have happened. But, the fact is that there's been essentially a $15 trillion unwind in global equities. There's a lot of markets that are down more than 20%. And it's only recently that the U.S. market began to catch up essentially with that global weakness. And actually, the other thing I would point out is that when we look at U.S. equities, we tend to focus on certain indices, the ones that we always look at. So that's either going to be the Dow Industrial, that's a relatively small basket of only 30 stocks, the S&P 500, and the NASDAQ. And the S&P 500, some of the damage in there is greater than the overall decline that we've seen. You could say, well, we're not technically in, call it a bear market, if you will, unless we're down, say 20%. We're only down 13% now. So, maybe that's not technically a bear market. It's more than 10%. So it's definitely technically a correction. But of course, if you sift through that, what you're going to find is that there's relative outperformance by a couple subsectors. And those subsectors are things like utilities and staples. And utilities and staples are sectors that we typically identify as being pretty defensive, right? So if you then take a look at what remains, I would say that, actually it's been a little bit bloodier, maybe than the headline S&P number and the amount of time that we've seen this decline might reveal. So that's just one thing I might point out.
So you're saying that technology and discretionary, these types of sectors are actually much further, have much higher declines than the S&P or the headline is telling us, because of the fact that you're seeing flow into more defensive sectors. Is that the gist of what you're saying?
Yeah, that's right. And actually, I don't know what tools most folks are using to try to take a look at how the market is doing. But even if you're just looking at OptionsPlay, why don't we just pull up a graph, for example, of XLE, which is the energy ETF. So when you're trying to say, okay, well, how are sectors doing? I can look at XLE and I get a snapshot essentially of how the energy complex is doing. I can look at XLI and see how that is doing, and I can look at XRT to see how the retail space is doing. But look at XLE. This is a sector. I think we can say it's profoundly hit bear market territory. Why is that? Because in the course of only 48 trading days, it's down 23.5%. And given how oil traded today, it seems kind of unlikely to me that we're going to see a rapid rebound in that. Now, I would point out that from an economic point of view, weakness in oil prices is helpful to the degree that you might see a more restrictive monetary policy. So if you start to see some tightening, if you start to see higher rates, and you're trying to take a look at, for example, the U.S. consumer and how much they can afford to spend on housing, which has obviously been weak lately as mortgage rates have risen, how much they can spend on car payments for the same reason. If they're spending less on gas, that's obviously going to be helpful, but that can only help a modest amount, and it has certain carry-on effects which might not be so positive. The energy space tends to be heavily indebted. There's a lot of debt on the balance sheets of energy companies, particularly those that are in the E&P space. And at a certain point, you begin to worry whether they're going to suffer the same kinds of problems they had the last time there was a significant oil downturn. Are they going to be able to, meet their debt obligations? And to the degree that those companies have to roll or turn over their debt, you have a number of compounding effects taking place, right? So where do they get their money? They can sell bonds. They can borrow money in the form of loans. The levered loan space has been relatively weak lately, and the reason is because those are floating rate debts that corporations take on. And if people don't think rates are going to go higher, the relative attractiveness of credit that has floating rates goes down. And there's only a certain amount of liquidity in there. If they have to go to the bond markets and longer term rates and credit spreads are wider, then they're going to pay more for that debt. And all of that is taking place at a time when their receipts, because of lower oil prices, are dropping. So that's a kind of a compounding effect that can obviously be very troubling for them. Now, I'll grant that my understanding is that the operating efficiency of a lot of those businesses has significantly improved, but we don't want to see even a relatively small credit crisis of any sort. That's not really helpful for equities generally.
Right. So what are your thoughts on interest rates, especially talking about potentially going from raising interest rates to potentially even tightening now, and kind of how you see that reflect in equity valuations, keeping in mind that we are coming up on earnings season. Share buybacks are potentially going to accelerate going into at the end of 2018, going into 2019. What are your thoughts around that?
So, as far as rates are concerned, I'll sort of allow the markets to be my guide on that. And there's two guides I can take a look at, right? So the first is the one we were just talking about, which is the equity markets. So if the equity markets, and specifically those sectors of it that are sensitive to increases in rates, the more heavily levered businesses are looking very poor, they're saying they don't want a rate increase because they're saying that they're not going to earn their way out of it. The other thing is yield curve. And the yield curve is essentially telling us the exact same thing. The yield curve is saying it's possible that the FOMC tomorrow gives us a modest rate increase. But then you look at 2, 3, 5, and 10-year spreads, and what it's telling you is that there's a decent chance that they may actually cut rates in 18 months. I mean, you shouldn't have a situation where the very front end of the curve is going up and then you've got other parts of it coming down at the same time. So, the rate markets are not forecasting a lot of additional tightening, a lot of additional rate increases. And if you take a look at the long end of the curve, it's also telling you it's not warranted, or I don't know about warranted. Maybe that's not quite the right word, because we would like to see some kind of a normalization from having a very prolonged and accommodative monetary policy. But what it's saying is that it cannot absorb it. I guess that would be the fairer statement. So I could give you my own opinion, but I think we're probably wiser just taking a look at what the markets are telling us. And the markets are telling us it shouldn't be done right now, and we're not going to see considerably more tightening in the next 18 to 24 months.
So couple that with the fact that, earnings season is coming up. Do you feel that at least certainly what I'm seeing is that company earnings do not look weak by any means? The growth of top line has certainly slowed down. However, we are still seeing growth, and this recent pullback certainly does make valuations come back from the stratosphere. Do you see companies buying more shares, going into 2019, and do you see that as a support for potentially of the markets?
Yeah, I mean, stock buybacks are always going to provide that support, for sure. I mean, you have an incremental buyer on the margins that's supportive of equity prices generally, and of course, it's also justifying it because it's returning higher rates of EPS growth to buyers of equities. If there's to keep the math simple, if you have 1 million shares outstanding and you make $1 million, that's $1 per share. If you buy back 10% of the shares, it's only 900,000 shares. So the divisor goes down, and the EPS for those who continue to hold the shares goes up. So you could have growing top line, as you pointed out, and I everything I've said probably has a really negative tone to it, and that's because I'm sort of naturally skeptical of the markets. I think I always have been, but the flip side to that skepticism is that we have seen good economic figures. We could argue we're essentially at peak employment, and we're beyond what I probably would have thought was peak employment if you'd asked me the same question 10 years ago. And we are seeing top line growth, and we're going to see faster EPS growth than top line growth, provided that we don't get some sort of notable inflationary pressures or other kinds of economic weakening. So when you start to see wages start to rise faster than they have done, presumably at some point that affects corporate margins. One of the things that we've seen during this particular economic recovery is that we've seen revenues increase dramatically. We've seen the cost of capital drop to all-time lows, and we haven't seen considerable inflation in the form of wage pressure, commodities pressure, and those sorts of things. And what does that do if you're running a business? Well, that means that your margins are going to be epic, right? So you have a rising top line and maybe rising margins. And in some industries, they seem to be managing the industries much better. I'm thinking now of airlines. We haven't seen this type of earnings power for an industry like that ever. I mean, up until this particular bull market, the entirety of the history of the airline industry was that they'd never made any money. You take out all the profits they've made and all the losses they've had, and you take all the companies that have come and gone, and you add it all up, and it was a terrible place to put capital. But that doesn't seem to be true anymore. So I think there definitely are, places where some companies look, remarkably cheap, and I don't see necessarily that they face a secular headwind coming up that should be problematic. Think about Federal Express, for example, as a company that's been very hard hit. The secular tailwind for that industry remains intact. The only headwind they face is potential competition from Amazon. And now they've got lower oil prices, which for anybody who operates jets is usually one of the largest operating expenses. For an airline, that has fluctuated between 20% of total operating expenses to as much as 50%, exceeding even their labor costs when oil prices got exceptionally high. So if you have a low oil price environment, a company like FedEx should do very well, and it's trading at 13 times. So that seems, relatively cheap to me. Then you have companies that have just a natural secular tailwind because of, the transformative effect of what's going on in industry. Cloud computing plays definitely fall into this category. Now, some of them are expensive. Amazon is an expensive stock, but AWS is probably the best cloud play there is. So that's obviously, an industry that's going to continue to grow, and Amazon's going to continue to grow. Microsoft, the exact same story. So I think there are defensive places to be. That would be my feeling about it.
Yeah, so I mean, I appreciate the different perspectives that you bring to this particular outlook. We certainly have been on the defensive, but on the bullish side over the last few weeks, because we felt that the markets were fundamentally a little oversold. We didn't feel that the fundamentals really justified the declines that we were seeing on our screens, which is why we took a defensive strategy of going along these stocks that are on the defensive side. A lot of General Mills, Mondelez, Oracle, Microsoft, these types of names that we were long. But I think that actually brings up to our next topic that I think I want to discuss with you is, what are the types of option strategies that you look at trading in these types of market environments where we're seeing quite a bit of volatility of that volatility, markets moving significantly lower and significantly higher just a week later and vice versa, whipsawing back and forth. What are your thoughts on, trading strategies for this type of market condition?
Yeah, so it's interesting. You mentioned sort of day in, day out volatility, week in, week out volatility. Check out, basically tick to tick, 15-minute to 15-minute or hour to hour volatility. I was taking a look at this today. We had a period starting at just before 2:15 this afternoon. The S&P dropped more than 1.25% in less than an hour, and then recovered ostensibly all of that decline in the ensuing 40 minutes, and then sold off a little bit thereafter. The intraday volatility we're seeing can obviously make executing trades a real challenge, because the things that you are trying to buy and sell, the prices are really moving around quite considerably. And I am certainly curious to know, within the audience of people who are listening right now, how many typically are buying options or selling them and so on. But our strategy, the strategy that we've advocated for several years, and the one that we use most commonly, is that we are generally longer dated options, and we are generally shorter dated options. So, for example, if I could just structure it in your mind's eye in a simple way, the S&P generally rises. We're generally bullish on equities. We want to be long dated calls. Options decay. We obviously want to offset that. So we try to offset some of that decay by selling near dated options, which will decay more rapidly on an absolute basis and as a percentage of their value, depending on which ones you select, and offset that. So we're long some delta. That means that our options positions generally I've never been, I think I should make this clear again, despite all of my probably negative sounding tone here. I've never been outright short the market. I've either been long or less long. But in my career, I've never been really net short the market. And actually, I would take it one step further and suggest that most institutional market participants, even when they are bearish and even when they put on short positions, are not really short the market themselves either. It's very difficult to make money consistently shorting stocks. You have all kinds of weird idiosyncratic things that can happen. Very often the stocks that you target may have very high short interest. You have squeeze circumstances that go on. Flows into the market tend to drop in bear markets. So one of the comments I've made probably many times is that I don't think anybody makes money in a prolonged bear market, including the shorts. But I think calendar spreads are a really good and interesting way to have options positions in general, because you can collect decay, you can have some delta, you can have some hedge against extreme moves. All of those are good things. And the other thing is that in a market condition like this, where near dated implied volatility, that is the price of shorter dated options, 30, 60, 90 days is what I would think of as being shorter dated options, is higher than the volatility of longer dated options. So I'm talking about 9 months and longer. We've generally seen that in these kinds of market conditions, those types of strategies do even better. The thing that, of course, everybody should bear in mind is that when you have markets moving like this, you're going to get some intraday volatility, day-to-day volatility, and it's not only going to be in the markets, it's going to be in your positions as well. I think we lost 3% in October. I'd have to double check those numbers. I don't have them right in front of me, but it was down about 3%. We were up about 3% in November. 3% moves for a fairly hedged portfolio is pretty significant. But of course, it's a lot less than what the S&P is moving around.
So that I really appreciated your comment on the shorting aspect, because we've been getting a lot of comments over the last few days, last few weeks about why are we not short the market. And I think being short the market in this particular time is very tempting. I think there's a lot of people out there talking about buying puts on a lot of these technology stocks, and many of them may have made some money in the short run. But I think what you said is very important, because we've been doing a lot of back testing on short strategies, and for the most part, none of them really make money in the long run. And I think partially there's a few different reasons. I think you touched up on a few of them, but number one, just the probability of the markets moving higher versus lower is skewed to the upside. Not to mention the fact that you have all of these different risks when it comes to outright being short the market or short an individual name that really make it extremely difficult to make money in the long run being short any specific name. So sounds like from what I'm hearing from you is that you prefer to be more tactical and wait out some of this volatility and go long when markets are a little bit calmer. Would you say that that's a fair representation of what you're saying?
Yeah, I mean, one of the things that is definitely the case is that our strategies are naturally less long the market when volatility rises. And that's actually a byproduct of being in things like calendar spreads, because what ends up happening is the number of options that you need to own and sell to get sort of what we favor as sort of a positive rate of decay, positive rate of theta, goes down. So our position sizing declines naturally as implied volatility rises. And of course, everybody on the call who's thinking, well, how do I size positions, right? Because that's a really important thing about investing. And we consider ourselves investors, although we trade options, which obviously expire very frequently. But we're trying to have a disciplined, long-term approach. And what ends up happening is you have to size your positions differently when the market is substantially more volatile, because you have to live to play another day. And you're going to start seeing much more acute moves in this kind of a market, and you obviously have to deploy your capital appropriately. Now, one of the things about that I would point out is that probably a lot of people on this call have heard of strategies like risk parity, right? So that was kind of a buzzword as a part of a systematic investment approach for the last couple of years. And I have a feeling that markets like this are going to shake risk parity investors, because the thesis there is that, yes, if an asset is more volatile, you put less money towards it. But oftentimes you may not know that until after the fact, after it's too late. So I have a feeling that some of the volatility we're getting is a natural byproduct of, you get some volatility, there's a reflexive effect. So that volatility builds, suddenly you're over allocated to that asset because it's too volatile to hold such a percentage of it. You end up selling some. Guess what happens? Well, if you're an institutional investor, that's going to contribute to the volatility. Right at the time, liquidity providers, and I've served both roles, right? So I've been a liquidity taker, and I've been a market maker. If the market makers are pulling back at precisely the opportunity that price takers are trying to liquidate their positions, it exacerbates volatility. And I think that's a part of what we're seeing right now.
I'm really happy that you brought that up, because that's really been my views of the market over the last few weeks, despite being wrong and despite having to cut my losses. And that's one of the things that I actually want to cover next is the fact that these sell-offs do not feel like they're huge. It doesn't feel like there's a lot of volume behind these sell-offs. It just feels like there's just a lack of bids or a lack of buyers, as there are natural sellers in this market. Would you say that that's a good summary of what you're saying?
I wouldn't mind seeing a little bit more volume because typically if you meet a bottom, even an intermediate bottom, it's going to be characterized by a couple of things, but there's usually a little bit of a washout panic that takes place. So the VIX isn't a perfect measure necessarily of how much fear there is in the marketplace. It's actually been surprising to me that we didn't see higher levels in the VIX recently than we have. It may be just because some of the institutional sellers of volatility got blown out in the Jan-Feb great unwind of the sort of the short equity volatility trade that underpinned a lot of those exchange traded products. But if I'm looking at something like Amazon, and Amazon's obviously down quite substantially, it was over 2,000 in Q3 of this year. It's trading about $1,500, so it's about down 25% from its peak. For a period there, we were seeing 10 million share days in it. And that was 10 million share days when the stock was higher. So when you think about how much money was actually changing hands in names like Amazon, it was substantially higher at the beginning of this year when the price was about where it is right now, but the volumes were higher. It was substantially more when the price was higher and volumes were about what they are now. And then we had this little bit of a sell-off. I wouldn't mind seeing kind of a blow-off where we had a real washout and then a strong reversal. I mean, one of the things I learned trading commodities was that things always tend to go farther than you think they will. And I became a lot more interested in sort of the technical factors that drive a market as a result of that experience, and recognizing, when you really did see the market sort of wash out whatever the dynamic was. If you could see these blow off tops and these strong reversals at bottoms. And we haven't really seen that. And we, take a look at how today was. We had two really bad days in equities. And, today we started off higher and we closed flat on the S&P. It's not really the kind of price action I would want. I don't know if that answers your question.
No, that absolutely does. I think that was exactly the type of point that I wanted to get across, and I think that brings up a very good point, to the last point that I want to bring up is about risk management, right? Because you mentioned that markets tend to overreact near the end of near the top or bottom. And I have to stress that regardless of what your views are in the market, whether you're bearish or bullish in this market, that, having proper risk management on your positions is extremely important, because no matter what, markets can effectively be irrational a lot longer than you can stay solvent. So risk management is absolutely key. And I have to recommend for all users here that are listening here that want to learn more about option strategies and talk about where the market's going to go, and we can talk about that till we're blue in the face. But at the end of the day, what makes us profits and losses into our accounts is the trades that we make. And in order to stay solvent and continue to trade another day and be able to ride sometimes when the market is going against your expected direction, is by having proper risk management on your positions. So one of the things that we advocate here is not risking more than a certain percentage of your account for any specific trade. And that realm is usually in the 1% to 2% range of your total tradable account in any single trade. And I just want to know, Michael, what your thoughts are around risk management and position sizing.
So I think, in an options context, the kind of numbers that you're talking about make some sense. I think some people, the size of their accounts are going to have some impact. It's interesting. When I was at the hedge fund, we specifically, our docs, our limited partnership agreements with the investors stipulated that we would not risk more than 5% of our capital on any single position. We actually filed to amend that to increase it to 7.5%. But I want to point out that 7.5% was on an equity basis, right? So that's different than if you're trading an options position with 60 days to go to expiration. If you have 7% of, call it $1 billion invested in Microsoft, that's $70 million worth of Microsoft. But 70 million isn't really what you're risking, unless there turns out to be fraud or something like that. But I'm just trying to put it in perspective. You might actually more realistically say that there's some possibility that your Microsoft position falls by, call it 20%. And so my real risk is 14 million. And if that is our risk assessment, then that would be a much more manageable 140 basis points of the total assets under management. So, I would agree with you in terms of your percentages, and I would add that you have to think about what the true risk of a position is. The true risk of buying a call option for $3 a share, so $300 a contract. If it's a standard contract, it represents 100 shares. You can look at that and say, well, if I had only $10,000 in my account, $300, that's 3% of my portfolio. Well, the risk of that may indeed be, you may be taking more risk by doing that than if you owned $3,000 worth of that underlying stock, if that makes sense.
Absolutely. And I think the math that we want to point out to users is that when you lose 1% of your portfolio, you need roughly about a little more than 1% return back to get yourself back to break even. If you lose 10% of your portfolio, you need about 11.5% return to get yourself back to break even. But the more you lose, the higher the threshold that you need to get back in terms of returns before you can get back to break even. And that's the key why you want to keep your positions to risking no more than 1% to 2% of your account. And I think the other thing that I want to point out is that with any trading strategy, it's realistic that you could have 5, 6, 7, 8 losers in a row. That is the reality of trading, and that you need to be able to have position sizing that allows you to weather sometimes a string of losses in a row.
Yeah, anyone who's ever tried to trade a martingale on a blackjack table understands that very well.
Yeah, absolutely. So that's why we always advocate, no matter what you're trading, no matter what market conditions you have, no matter how bullish or how bearish you are on the market or a single name, the best thing to do for your portfolio is to manage your risk correctly. Because at the end of the day, we don't have a crystal ball, and the markets can be rational longer than we can stay solvent. And the best way to stay solvent is by managing your risk. So with that, Michael, I just want to thank you for your time. What I want to do is I want to jump over to questions. We had a lot of users submit questions before the webinar, so I'm going to go through those first, and then we'll answer any Q&As from users who are submitting questions live during our webinar. So for the first question, this is a great question. I think it's pretty timely for what we're currently talking about here. The first question is, what are the portfolio protection strategies using options on your platform? So as far as portfolio protection strategies, the one strategy that I think that comes to mind that's fairly simple to deploy is simply a put option on either an ETF, a broad-based ETF, or a broad-based index like the SPX or NDX. Michael, do you have any thoughts on portfolio protection strategies besides buying a put?
Yeah, besides buying either a put or potentially a put spread, I really like put spreads in certain cases, especially in single stocks. One of the places where we're going to go back in time a little bit, but this was pre-split for Apple. But folks may remember Apple trading up to, the $700 level. This is again on a pre-split basis, and then it fell back to started to fall a little bit, but for many of the same reasons that it has seen some weakness lately, which was that folks were wondering whether, the iPhone refresh cycle was going to provide basically another leg higher, whether it was going to reach some sort of stasis or whether, they might actually fall prey to, competition. And what interested me about that situation was that I saw that as those concerns were realized, implied volatility, the price of put options on Apple began to rise. That might not be all that surprising. What did surprise me, though, in particular, was that more of the disaster type puts, that the implied volatility on those was also rising very, very sharply. And the reason I found that to be so interesting was because Apple is not a levered company, and it was even less so then. At the bottom of their balance sheet was an enormous bucket of cash. They had about, at the time that I'm speaking of, they had about $150 billion in net cash. And you had people out there buying, 450 strike puts and paying up for them relative to the at-the-money puts. Now, I could understand why you might say Apple shouldn't trade at 11 times earnings if their future iPhone sales were going to be less than they are today. And that their growth prospects were dim. That was the concern at the time. It proved to be ill-founded. But what really confused me was why people were buying those disaster puts. If they didn't sell another iPhone, it's not like the company was going to go out of business. They could just sort of close the doors and roll up, and at the bottom there's $150 billion in cash. So that implied volatility of those downside puts was definitely way too high. The volatility of the equity should diminish when there's a huge bucket of cash on the balance sheet of a business. And to help everybody understand this, because it's something I feel is very lost, especially these days where we have a lot of companies that have levered up. They have borrowed money in the debt markets. They have used that to buy back shares. So as a value of the total enterprise, the value of equity has declined relative to debt. And as that happens, equity volatility increases. But companies that have huge balance sheets of cash, what happens is those equities become less volatile as the price goes down. Imagine it this way. If you had a house that was worth $1 million and you owed $800,000 on it, okay, and the value of that house goes down by 10%, how much of your equity did you lose? You lost half of it, right? Because the equity was only $200,000. Now the house is worth $900. The 800,000 in debt still stands. So you've lost half of your equity. The equity is really, really volatile. Well, now imagine that house was worth, this house was actually belonged to, some mob boss. And the reason that house is worth $1 million is because the house is worth 200,000 and he's got 800,000 in cash sitting in the basement. Well, now if the value of the house declines by 10%, the value of the house was only 200, it went down by 20. Now the house is worth 980,000 and your equity was all of it, right? So that balance sheet issue is something you want to look at when you think about put spreads. If you look at single stocks and you're looking at something that has a massive amount of debt relative to equity, put spreads are probably going to look good, but they probably aren't because the equity is likely to be much more volatile. In cases like Apple, Microsoft, name any of these companies where they have tremendous amounts of net cash, those are situations where, selling downside puts to help you finance the purchase of ones that are closer to at the money can make a lot of sense because they're not going to go out of business. They, even if they stopped doing business today, they wouldn't. Not GE.
That's a very interesting strategy. So for the companies that you feel that have the fundamentals and the cash to back it up, sell a far out of the money put, take that premium and help that offset buying a longer term put.
Yeah, I've done that. I mean, I'm not going to recommend this for people who are new. I've even done that on a ratio, meaning that, if I could see the stock pulling back 15%, so I'll buy an at the money put. The out of the money puts usually on these companies are, not a good source of premium unless you have situations like that case in Apple where, and this is something you have to look case by case, but, I'm going to look for situations where I can collect at least 20% of the premium I'm spending for every option that I sell. So, if I spend $1 to buy a put, I'm hoping I'm going to collect at least 20 cents on the side that I'm shorting. Beyond that, that relationship, it becomes a little uneconomic because your transaction costs and the other things that start sucking it up make it less advantageous. But you want to take a look at the price of options in the context of how levered the equity is in the companies that you're trading. That's, I think, an important thing that I rarely hear people talk about it, and it's something, even when I first started trading options, was something I kind of figured out. I always felt like the people who put me through my training program shirked their responsibilities on that one.
Well, thank you for your input on that. And if you want to find out more about hedging your portfolio by buying put options, please visit our webinar series. We have one specifically on buying put options as a hedge, specifically using both ETFs and index options. I highly recommend you to take a look. Our next question is from Ron about writing cover calls. Now, I think the question here really comes down to Ron saying that there's not a lot of information on rolling techniques when it comes to cover calls. Is there a place where roll strategy is well outlined? You can address the best practice behind rolling a cover call position. I'll just start off by talking a little bit about, the fact that roll positions, in my opinion, it's not a strategy in itself. It's really just closing out your existing position and initiating a new one. And I believe that your way to go about doing this really is just pretend you don't have a cover call. What cover call would you sell next? And use that as the strategy that you would roll to, because you're effectively just closing out your existing position and opening up a brand new one. But because you're packaging into one single strategy, we're now calling it a roll. I don't know if you have any thoughts or things to add on that, Michael.
Yeah. So first of all, I think selling covered calls is a great strategy. Just start with that. Just for people who are just starting, I think it's a great way to do so. You're really hitting on one of the things that becomes a challenging thing to manage, though. So when is selling covered calls an easy strategy where you just feel like a genius and you really don't have to worry too much about it? You buy a stock for $100, you sell a 45 or 60-day call option that's 2.5% to 5% out of the money, and the stock basically chugs sideways and the call option decays away, and you do it again and again. And hopefully you're collecting maybe 1% of the underlying equity price every 30 days or so. So you have an equity that isn't moving a whole lot, but you're making 12% in terms of premium that you're yielding from selling these covered calls. and you feel like a genius, and it's a great strategy. But what happens if you sell that call option and the stock goes up 10%? 30 days later, you own the stock at 100, it's trading at $110, you're short the 105 call. What to do? Well, the first thing I would remind everybody, and this is true for selling covered calls, it's true for every strategy you engage in. And actually, I didn't coin this, but I've heard a lot of my colleagues say it, especially guys on the future side. They will say you only trade from settlement. And what that means is, every day you have to look at your positions with fresh eyes. So the first thing you need to ask yourself in that circumstance is, do I have information now that I didn't possess before that makes me think differently, either about the stock or the options or both? And stocks will fluctuate. That's what they do. So if you don't have something new, like, for example, if earnings didn't come out and suddenly they said something that's sort of transformative to the valuation, so you had a lockstep jump up in the value of the equity. So in the absence of having a different view, if your goal was that you wanted to own the stock at 100 and maybe you figured that it had 10 to 15% worth of upside in, call it, 18 months or something, and that view hasn't changed, you might just want to say, okay, well, I'm going to wait until relatively close to expiration, so that most of the extrinsic premium has gone away. I'm going to buy back my short option, and I'm going to sell another option against my stock, maybe at the 110 strike now, or 112 and a half. You are going to very likely take a loss on the call option that you sold now that it has run through it. You have at least offset that, though, by the increase in the equity. And depending on the tax situation, so I'm not a tax advisor, I'm not giving anybody any tax advice, but I will make a quick point, which is that if you do the trade I just suggested, you may be preserving a long-term gain in your equity, which you have not realized, but you might be realizing a short-term loss on that short call. So depending on the tax circumstances for the year and how you time that, you might actually be harvesting a tax loss, which can be beneficial. So it's not like there isn't some value at times in that. So that's just a quick point I would make.
I actually think you make a really good point, because I think many of us find ourselves sometimes in the position where we've either bought a call or sold a credit spread or bought a debit spread, and we're losing money on that trade and we're approaching expiration. And I think this is probably more of a common question where I get where the question is, should I roll this position into the next month? And I think you bring up a really good point. The question to ask yourself is, do I have any new information that I didn't have when I first initiated the first trade? Because we tend to find that some traders will double down on a trade, especially a trade that's losing. You'll double down by rolling it out because you think you want more exposure or more time. And that very well may be a good trade. However, I think the thing that you always want to ask yourself is, do I have new information that I didn't have in the previous trade that basically justifies entering or taking on more risk by rolling out to another trade? And I think that's really the question, the fundamental question you have to ask yourself when you are about to roll, is there new information, or are you just trying to get back to break even because you've lost money?
Yeah. No, that's a good point. Would you initiate the resulting position today? So in this case, would you be comfortable remaining long $110 stock that you thought was going to go to 115 and selling the 110, 112 and a half call against it, had you not initially sold the 105? And if the answer to that is yes, then you should roll it. If the answer to that question is, I would sell the stock because I was only thinking it was going to go up 10% in the first place and it's already done that, well, then you take the whole position off, right? Yeah. So, and I have seen this professionally. We've seen circumstances where people were trading basically their net liquidity, their P&L from day to day, rather than some thesis about the things they were trading. And the example I'll give, and I'll give it very quickly, was that we got a phone call at our post one time. The names of the parties involved will remain lost to the sands of time to avoid embarrassing anybody. But somebody from Goldman Sachs called us and said, one of your traders he just gave us a series of very strange orders. And I said, okay, well, tell us a little bit about it. He said, well, he shorted 25,000 shares of XYZ. That's not that uncommon. And a few minutes later, he bought 50,000. Okay. So he covered his short and went long. And then he sold 100,000. Like, what? And, when he put in an order the other way on 200,000, we said we had to call you first. Well, he had to call us now. He was shorting it, then he was buying it, then he was shorting it, doubling down. What was he trying to do? He lost, then he tried to double down the other way to make it. And he could have doubled down either way. He could have pressed the short instead of saying, oh, I'm wrong, so now I'm going to go double the other way. If you find yourself trading because of what has already happened, chances are you shouldn't be doing whatever you're doing. One of the other challenges, I just want to make this one quick point just on the covered call thing also, and that is that what if you own a stock, that same $100 stock, you sold that high strike call, now the stock is lower, 10, 15%, it's trading $85, you cover your short call, should you now sell a call at 90, right? Because what happens if it rebounds back to 100? You may not even get back to scratch, right? So that is a common question that I will sometimes get. And I will tell you that one of the things that we have done at the hedge fund, this is, we're more sort of broad market now, but in circumstances like that, we would sell calls on stocks that we were willing to sell at higher levels when they were trading, closer to our target range. And we would sell puts to add to our equity positions on stocks that had fallen and we're now back to levels where we actually would have been comfortable adding more to them. And in the middle, if we weren't quite sure, we might use stock recovery strategies. Now, a stock recovery strategy is functionally very similar to selling a covered call because you're long the stock and then you buy one near at the money call and then sell two higher ones. And basically, you're still net short calls because you sold two, you bought one. But what you're trying to do is take advantage of the same dynamic, but do so while the price of the stock is maybe below where you'd first gotten involved with these types of positions. So that's, I don't know how often you guys, advise those types of strategies, but it's something worth thinking about. Go ahead.
So that's actually one of the questions, what do you do when your stock's down 30% or more? How can you sell covered calls? So I'm hearing two strategies. These are certainly a bit more on the advanced side, but the first one was sell puts and calls at the same time, right? Because you're saying that if the stock's down...
yeah, we would. I mean, that depends on how far the stock had fallen. We might just sell puts so that we could add to a position at lower levels, so that we were back up to, say, a target amount that we wanted to own of the stock. Obviously the amount of capital in your account and how much you want to allocate to a single name is going to end up having an impact on that. But what I'm saying is that we would sell calls and puts tactically depending on how far the stock was from our target price. That is to say where we wanted to sell it if it was a long, or buy it back if it was a short. And our entry price, which is how far down the stock would need to go before we would be inclined to buy more of it if we were long, or sell more of it at a higher price if it was a short. We did both long and short stock positions at Ivory. So that's a common strategy, and it's not just common to that fund. That's a very common strategy for well-known managers. Leon Cooperman, former head of Goldman Sachs Asset Management, who runs Omega. That's a really common strategy for them. And
so the stock recovery strategy that you're referring to, so you
is a 1-by-2 call spread.
Right. So
you buy one call and sell two more against it at a higher price. And the idea there is that you're going to double the return. So let's use a really simple example. And actually, we were talking about FedEx earlier, and FedEx, just reported earnings while we've been on this call. And, the results don't, at least initially, seem to be all that well received by the market. The stock closed at 185. It's trading 174.25, give or take looking at my after hours quotes that I'm seeing right here. So let's say you owned the stock at 185 and, you were short 190 calls going into earnings. And the reason you did that was because options implied volatility was high going into earnings, which it was. It would not have been a bad trade, I don't think. But what's going to happen tomorrow? Well, two things we can be assured of. The 190 calls are going to be substantially cheaper than they were as of the close today for two reasons. The first reason is the stock's $10 lower. And the second reason is implied volatility is going to fall considerably because the catalyst that was elevating the price in the first place has come and gone, earnings. So what do? Now you own the stock at 174. You used to own it at 185. You collected some money on that short call. You cover that. Okay, that's step one. Step two is you could certainly take a look at trading a 175, 180 or a 175, 185, 1/2 call spread out in time for as close to even as you can get it. And what's going to happen is that if the stock recovers back to 185, which is where it closed today, you're going to make your money back on your long stock. That lower strike call that you bought is now going to increase in value. Now, at that point, if you just held that position until expiration, you're going to get called out of both your equity and that other long call. You're effectively, just like in a typical covered call scenario, you don't own any more of the upside, but you would actually see some profits if you held that to expiration. We'd have to see where the prices open up tomorrow. It'll be very easy to do that on OptionsPlay. You could just, go out to, let's take a look at what expiration, you might consider. It's probably going to be an expiration that certainly precedes any immediate catalyst. So that will probably be, January or maybe February options. And, you can take a look at what those are going to look like. But to put things in perspective, a January 175, 185, 1/2 call spread today, that thing, which is, probably a relatively flat delta trade, would have been a slight credit. It's probably going to be about even tomorrow, right? So that would be a perfect example of a way that you're sort of in a synthetic covered call. There's more options involved. It seems a little bit more complex, but if you put it into OptionsPlay, the profile you're going to get is going to look exactly like a covered call, or very similar to it anyway. It's going to have a little kink in it because you're going to get an accelerated profit between 175 and 185, but
right.
And then it'll level off. But it's really going to look very similar, and synthetically they behave in much the same way.
Thank you so much for your input on that. I think that's a great takeaway for, what ways you can try to recover some of your losses if you are down on a stock. So next question, which I actually really like, because, and this is part of what I think that our traders don't necessarily get a perspective on, is the question is, can market makers and algos see our stops when trading options? And I think this is a question that a lot of people have about this mystery about what market makers do and how they interact with your orders. And maybe you can provide a little perspective, because I think a lot of people are concerned that, when I lose money, market makers are making money, or vice versa. So you always feel like this is a zero-sum game. So if you can shed a little light into that, I think that would be great.
Sure. Well, it's not entirely zero-sum. That's the first thing I would say. And the reason for that is because the market makers on the options side trade vol, and a lot of people who trade options on the retail side trade direction. And so your positions are not a complete offset to the positions that market makers may have. And actually, one of my earliest profitable trades as a market maker is probably a really good example of that. So back in the 90s, my first good size trade that I can remember was I bought 450 at the money 4-month straddles in IM. IM was a company, Ingram Micro was the name of the business. It was acquired a number of years ago, but Ingram Micro was sort of a technology. They sold computer technical equipment. It's basically a B2B business. And that was a very profitable trade. It was a situation where every single day when the stock went down, because I was long gamma, I could buy some stock, and every day when it was up, I could sell some. And I was basically trading the gamma that position gave me as the stock rose and fell every single day. And I will tell you that for about 45 days straight, that position made about $5,000 a day. So you can see why it's, even now, more than 20 years later, it sticks out in my mind. But the interesting thing was that the stock actually didn't move that much through that same period. So whoever sold that straddle to me could have actually ended up being profitable on it. If all they did was sell the straddle as the stock rose and fell, if they did nothing else, it decayed away and they made money. And I bought it and I hedged this thing continuously, buying and selling stock like mad every single trading day, and I made money. So it's not exactly zero sum. It is right for people to be concerned about transparency with respect to the information that you leak to the marketplace. So, once upon a time, yes, some market makers could see orders on the book. Lead market makers in exchanges that didn't have specialists might have access to that, and specialists on the exchange that had them could see that. That's because they served two roles. They represented customer orders, and they also worked as a market maker, and that information leakage was valuable to them. But that doesn't really happen anymore. Nowadays, when you put an order in to the market, or if you have a limit order, no market maker can see that. They don't know where your limits are. They don't know where your stops are. And so I wouldn't be excessively concerned about that. The marketplace for retail investors has gotten progressively fairer and cheaper for as long as I've been in this business, pretty much continuously. And it's one of the reasons why, locals that used to stand on the floor and only trade a few contracts a day and were able to make a good living can't do that anymore. There just is not as much vig in making markets anymore. And that's bad for market makers, but it's good for retail investors.
I think that's a very good summary, because that's my perspective of the retail landscape. Is when you trade at one of these major brokerage firms these days, you are getting far better executions from market makers than what we used to get. Price improvement, auction facilities are all improving the prices that I'm actually able to get filled at. And this is right smack in the face of what we're actually seeing on the screens, because what we're seeing on the screens is that bid and ask prices are
widening
wider, but in reality, I'm actually getting filled closer and closer to the midpoint on my trades, which
I would use limit. Yeah, be sure to use limits. But it's interesting because there used to be a rule. It was a maximum spread rule. So when I first started, options traded, the minimum price difference was an eighth. So I'm obviously dating myself a little bit, but by and large, options markets were a tight market would be an eighth wide. Typically a quarter, 3/8 to a $0.50 was much more typical. The standard brokerage for an institutional client was $2 a contract. And those prices are clearly much, much lower today. You will see spreads that are suspiciously wide on the screens, but to your point, you can almost always trade inside of those, and you should use marketable limit orders. And that, by the way, is an important point. There's a difference between a marketable limit order and just a limit order. If the market is $3 bid at 10 cents, and you put in a 305 bid or a 305 offer, that's a marketable limit order. If you put in a bid that is 270, so that your limit order bid is below the prevailing bid in the marketplace, or at 320, which is above the ask price, that is not a marketable limit order. And unless you're monitoring those positions, it's fine to do that. But immediately, marketable limit orders are probably more likely to get favorable executions relative to the prevailing bid ask than non-marketable orders will sometimes. And part of that is because the market just moves fast. And as it runs through your limit, you may find that, you wish you hadn't had it there. So, I try to, enter my orders at the time that I want to execute them, and I use marketable limit orders to do so.
Great advice. So next question, and I think this is a question that's probably on a lot of people's minds, is can we make money trading options in this choppy market where the market's up 200 points one day and down 500 points the next day? Any thoughts?
Way more money gets made in the options markets in circumstances like this than when the opposite is true. And that is true actually for people who are both buying and selling options. The ones that are making money on the long side, and in many cases, I feel like they have better sort of directional insights and intuition than I possess. If I was able to combine what I know about the options markets with some of the intuition and well-timed trading that I've seen from some other market participants that I've come into contact with, I'd have, long since retired to some place and only ferried myself in and out on my jet. And I do know some people who are doing exactly that, and for that precise reason. We have been most profitable in our calendar spreads when we have sold options in periods of high volatility. So in 2008, for example, I remember we had a particularly, this was when I was running basically, I had about 150 names in my book, in my portfolio at the time. And we had a very bad month, but the next month, mostly from collecting options decay, which I guess would have been November of 2008, was one of the most profitable that we'd ever had. And the reason was because people were willing to pay anything for an option, even things that didn't make any sense, at least not from my perspective. And what ends up happening is a lot of times people are most desperate to buy insurance, to buy protection for their portfolios after they're already down. They often will say in the insurance industry that one of the best things that can happen to their profitability is for there to be some kind of a catastrophe because they can raise their premiums. And, you're insuring against the next catastrophe, not the one that's just happened. So from my perspective, especially when it comes to selling premium, this is a great opportunity. Consider every stock that any one of you might ever want to own. If you ever thought about selling put spreads on it as a way to be modestly bullish, you have to recognize that you're getting more premium for those trades. And if you are forced to buy the stock, you're getting it at much lower prices than you otherwise would have. Those are two things that are better now than they were 60 days ago.
Yep, and that's partially why we are selling some put spreads going into this market at these extremes, despite some of the risks to the downside. We are mildly bullish on the market, and at this point, we're able to take advantage of a collapse in volatility if the market's just at least stabilized. So great point there. So another great question that I think you can provide some perspective on, and I think a lot of people may look at this type of data. The question is there any advantage in trading options knowing unusual options activity? I know you the Nigerians well, and they followed this type of strategy. What are your thoughts about looking at unusual volume?
I just realized that I can type answers in over here. I didn't realize that. So for those who thought we were ignoring your questions in the chat, I only just realized that I could respond to that. Unusual volumes. Yeah, that's an interesting one. Unusual volumes by itself, you need to be able to know more than just whether the contract quantity is unusual before you can make any kind of determination on that. And let me give an example. So actually, maybe I can give a specific example. Maybe I can find something today that we can take a peek at. ADP, looks like ADP had some unusual options activity today. Okay, so yeah, ADP traded 10 times its average call volume today. It traded over 20,000 calls. The 20-day average volume is 2,000. And actually, if you look at the 1, 5, and 10-day numbers in terms of volumes, it traded 349 call options yesterday. Traded an average of 1,400 contracts a day over the last week, and about 1,500 over the last 2 weeks. Okay. So you could say, oh, there's, tremendous amount of call volume. Well, we don't know what they did, right? I have no idea just from that, whether that's information I can use in any way. And even if I did, is it telling me what I think it is? Now, if all I did was say there's a massive amount of call volume, then you would assume that was a bullish, a bullish indicator. Somebody with institutional pockets was making a bullish bet. And then they might say, okay, well, where was all of that activity concentrated? Well, I can see that there was 5,000 January 140 calls traded. There was only 698 open interest. So that was definitely, an opening trade. There's 5,000 February 145 calls traded. That open interest was only 588. So that clearly is opening as well. Was it a buyer or a seller? Does somebody own 1 million shares of ADP and they just decided to sell some calls against it at the 140 and 145 strikes? Those would be the options that a call seller might look to, right? So maybe a little bit further out of the money than you normally would for that period of time, but that's certainly a possibility. So we need to examine that a little bit more closely and say, okay, well, when those things traded, did they trade as a spread? Are we sure that they were bought, and so on? So taking a closer look, what do I find out? Well, I can see that the 140 calls, the January 140 calls, and the January 130 calls traded at the same time at 241. Well, this could be kind of an interesting story. How about this? And it traded on a ratio. 2,500 January 130 calls traded 530, 5,000 January 140 calls traded 145. Well, what was the kind of trade we were just talking about a second ago? We were talking about a 1x2 call spreads. That was a 1x2 call spread, right? So when you look at that and you say, okay, well, that seems like a pretty compelling situation. What you find out is that somebody bought that 130, 140 call spread. Well, if all I did was look at unusual volume, I would have said, well, the most active options were the January 140 calls, 5,000 of them traded. Was it a part of a bullish trade? Yeah, it was. Should you go out and buy the 140 calls? Well, this institutional trader didn't do that. They bought 2,500 Jan 130s, they paid 530, and they sold 5,000 of the Jan 140s. So you might say to yourself, well, maybe that's a trade I'd rather be in. I'd rather be long the 130, 140, 1x2 call spread. But here's another point. Do you think they're naked short ADP at 140? Or do you think they're doing this against a long position as a stock recovery trade? Well, that's almost certainly what this trade is. So if all you did was say, I'm going to look at unusual volume, and that's going to be my guide, you would have looked at the January 140s, and you might have thought you would go and buy them. But the nuance of what actually happened is maybe a little bit more interesting. 2 big 1x2 spreads traded. Somebody bought 2,500 by 5,000 of the Feb 130, 145 call spreads, and they bought 2,500 by 5,000 of the January 130, 140 1x2 call spread. So this is almost certainly a stock recovery trade like the one I was just talking about. It's an interesting coincidence that I happen to be mentioning that, and that's what we saw here.
So I think the thing to take away
caution is the answer. And by the way, for anybody who's paying any attention to ADP, I mean, this is a stock that was trading 145 at the beginning of the month, right? So they're hoping to at least make some profits if the stock recovers simply back to the level where it was on December 4th.
Yeah, I think that's a really good point. In terms of looking at unusual volume, you really have to take everything with a grain of salt. Number one, because it's a bit of a guessing game as to what is the trade to begin with, and then a guessing game as to what is the rationale behind the trade. Is it an outright bullish or bearish trade? Do they have stock? A lot of times these large trades do have stock tied to the position, so If you see a large put buyer, perhaps they were just trying to hedge some stock. Perhaps they're not necessarily.
Yeah, it could be a put in stock. I mean, obviously, one of the things that's a little bit different, and you're probably getting a sense of that, is that, I'm actually looking at the exchange, the raw exchange data myself. So I can see that these were spreads. I can see the millisecond that they were executed. I can see that they were tagged as opening on the exchange. And in some cases, if a trade is interesting enough to me, I'll make some calls and try to see if I can't reach the bank that actually did the trade, and maybe they'll tell me. Sometimes they will. But most retail market participants are not going to get the kind of access where, they can say, "Hey, what's the scoop here? What are you doing?" But I mean, there are a lot of pieces I could put together that'll probably support my suggestion, which is that, first of all, this is somebody who has at least 500,000 shares of it. They're almost certainly a 13F filer and holder in the name. Chances are, and by the way, 0.72 Asset Management, which is Steve Cohen's hedge fund, they're certainly comfortable trading options. They hold not inconsequential positions in this thing. They're a decent candidate. But if you really dig into it, you might be able to tease out who it was, or even have somebody tell you what was going on. But I would probably be very cautious saying that just because you see a big chunk of volume, that you can assume that if there's a big chunk of calls trading, that means that they were bought. And furthermore, that means that you should also buy them. I think that's, that's not something I've ever done. And I don't necessarily encourage others to do it. We do, however, on CNBC talk about it from time to time. And I will say that I will do at least the kind of due diligence that we're talking about here, which is try to establish, were those options actually bought or sold? Were they opening or closing? Was it against a stock position? Is it part of a spread? So at the very least, if you're going to try to follow unusual volumes, answer those questions at least, because volume on its own isn't going to be that revealing if you don't know whether they're bought or sold or why or what.
That's great advice. So just moving on to the next one, we don't have a lot of time left. I just wanted to address this question that I think is more so for those of you that are more longer term investors, as using leaps as an alternative. The question is, when you're buying deep in the money calls, why do they make more sense than buying at the money or out of the money? The question is, apart from requiring more capital to be put at risk, what are the drawbacks of buying a deep in the money call versus just outright buying an at the money call? And if you intend on holding the stock long term anyway, doesn't it make sense to write calls against it in a bear market? I think this is really what we would typically call a poor man's cover call. So instead of outright buying the stock, buying a deep in the money call, which many times will cost you a third to a fifth of the cost of buying an outright stock. And you could sell cover calls against that long call. Mike, do you have any thoughts?
Well, I think, the first thing is that anybody who heard my earliest remarks will know that in general, I like being longer dated options, and I like selling nearer dated options against it. I have frequently heard people talk about buying longer dated in the money call options, and as a proxy for being long the stock. And I will say that that's not typically the approach that we have taken. We typically will buy at the money options, long dated, and then sell slightly out of the money options against it. Sometimes, even slightly in the money, depending on where the underlying has migrated in the meantime. And we have little algorithms that basically tell us if the stock moves more than a certain amount, then we'll adjust our strikes and so on. One of the advantages that, and I'll tell you why, and people may differ in their opinion on this. One of the advantages to owning an option is convexity. All right. So what do I mean by that? If I own a call option and it takes off, I get 1-for-1 participation to the upside. But if it goes to zero, I lose the premium. So my payoff instantaneously looks like a level line below zero to the left as the price of the underlying declines, and then it curves and goes up at a 45-degree angle to the right. I like that characteristic. The break point is the strike. That's where the bend takes place. And the question I would ask myself is, well, why would I want that bend to be below the current stock price rather than at it? The advantage of having options is that I don't need to take that loss. So if I bought a 20% in the money call option, then I'm basically taking at least 20% worth of downside risk in addition to whatever premium I spent. And that gets us to the heart of the question. The reason people do that is because the extrinsic premium, the amount that that option is going to decay, is lower for that deep in the money call, arguably, than it would be for an at the money call option. And that's a fair point. But the thing to ask yourself is, would you want to go buy that corresponding put option? So I've got $100 stock and I buy a 1 year 20% in the money call option, a deep call option. Would I buy a 20% out of the money put that expired in 1 year on that stock? And if the answer to that is no, well, essentially buying a 20% in the money call option that expires in a year is the same as buying the stock and buying that put. So I have a problem. So how do I deal with that? Well, the way I deal with that is I say, okay, I'm going to buy an option that's closer to at the money, so I take less delta risk, and I'm just going to have to be more active about managing my options on the short side to offset that decay, because my decay will be higher, but that's okay. Decay is the price I pay for getting the convexity. That's the part that I like. And so I love the strategy. Personally, deep in the money call options, never done it. Maybe somebody could show me a white paper that revealed why that's so much more compelling than the approach that we've taken. But, we get better than market risk-adjusted rates of return doing it the way we do it. So maybe we're just stubborn.
So, okay. So what I'm hearing from you is that buying an at the money call and having that extrinsic value that's decaying while you're in that trade is better off. You're better off with that than the deeper in the money call.
You're using this as a proxy for a covered call where you spend less money. And what I'm saying is that, let's use a really specific example. Heck, we're on ADP. Why don't we use that? Okay. So let's say that you were going to sell a covered call in ADP. All right. And we were going to buy a longer, I'm not saying that this is the trade. I'm not recommending ADP. We're using this as an example. I haven't even given it any thought about whether ADP is the stock for anybody to consider. So just want to make that, give that little proviso. Okay, so let's imagine that we buy an at the money call that expires in 1 year, December 19th, 2019. Okay. So how much would that option cost? Well, at the prevailing implied volatility, I'm looking at it theoretically, by the way, whereas you'll probably be able to find the nearest option and tell me. That for me would be the 130.005 strike option. So you can go and look up the December 2019 or January 2020 option at the 130 strike.
1490 versus
okay.
money. Let's say a 120 is 2130. So an extra $500 or so, an extra $600.
Okay. All right. So now the real question that we're getting into here is, well, I wanted to sell a near dated option so that I could offset the decay. I want to be long that longer dated call, and then I want to sell a shorter dated one against it to collect the premium. So the next question is, well, what option do I then need to sell? Well, instantaneously, the decay of that option is about 2 cents a day. That's the theta, okay? So if the theta of that option is 2 cents, there are a couple things I could do. One of them is I could sell one 90-day 130 option. So I could buy two long-dated ones, sell one. I have no decay, right? Instantaneously, I have no decay because the decay of my near-dated option is more than twice the decay of that longer-dated one. So I'm net long options because I bought two, sold one. Another possibility is I choose an option that's a little bit further out of the money. So maybe I look out to March and I say, okay, well, what if I sold, a 5% out of the money call option? Okay. So if I sell a 5% out of the money call option, I bought an option that's 20, I'm selling one that's, just shy of $6. Well, that 5% out of the money call option is decaying at 4 cents a day. That's double what the long dated one is. So now I'm long delta, which means I have some long exposure to the market. I'm positive theta, which means I'm collecting decay over time. Now, so far, everybody who's listening is thinking, well, this is perfect. It sounds like free money. It's not free money. It's not free money because if this is what's called a path-dependent trade, if the price moves violently away from these strikes, my long-dated call option that I spent, $20 for, that could go to zero if ADP, in this case, fell to $60 overnight. That call option is going to be worthless. So is the one I sold, but I only sold one for $6. I paid one for $20, so I just lost $14. So you end up with a payoff profile that doesn't do well if the price of the underlying moves violently away from the strikes, where you essentially have exposure. You have this, that's the path-dependent nature of it. If it exploded violently to the upside, if somebody came out and said, Amazon said, we're going to buy ADP for whatever crazy reason, or maybe Salesforce did, it's probably a more reasonable suggestion. We're going to pay $260 a share, double the prevailing market price. Well, you're going to lose your extrinsic premium. You're going to make some money because you own a lower strike call, and then you're short a higher strike one. But on balance, that's not going to work out for you. So if it moves violently away from the price, that's not helpful. But if your goal in buying long-dated options is so that you can sell nearer-dated ones against it to collect premium, it doesn't have to be deep in the money to get positive theta, because the rate of decay of options accelerates very sharply when the options have 7, 6, 5 months in. And so you really don't need to go to that really deep option. I mean, to me, it's not worth it. I'd rather pay a little extra premium to have the at-the-money option and get the benefit of that gamma and get less delta risk.
So that's really great advice. Buying at-the-money calls for long-dated calls and selling short-dated options against that to offset that. So last question here that we have time for, and I'll try to open this up for Q&A for those of you that have live questions, is a question that we have here is, when creating debit spreads, do you have guidelines for the dollar difference between the strikes? Also, could you go over how to calculate the probabilities of profitability based on the option premiums? So let's tackle those one at a time. Do you have any guidelines on the the strikes for a debit spread?
Yeah, I do. So a couple of those things might go actually to your view of the underlying in the first place, right? So before we get to the probability question, ask yourself that. So, what's your target price? If you owned the stock, let's say you're buying a debit call spread. If you own the stock and you were hoping to sell it at some higher price because you thought it was going to be higher, what might that price be? Well, again, we'll just stick, because I like to use the same example. We'll look at automatic data processing, ADP, the stock we were just talking about. $130 stock. Maybe your target price is $150, right? So if you owned it, you're hoping to sell it at $150. Well, to me, is there some chance that the stock rallies through that for reasons unforeseen? Sure. But if you've done your work and you have a valuation, and maybe it's not even your work, somebody else's work. I mean, as it happens, the average, there's I think 24 analysts at major firms that cover ADP, and the average analyst price target's $155 right now as I look at this. So you say, I'd be happy to sell it at that level. And maybe that makes sense for a host of reasons. One of them could very simply be valuation. I mean, right now the company's trading at 23 times forward earnings, which is above, its peer group, which is trading around 18. So if somebody said to you, okay, well, I'm going to give you, a 12% premium even to that, so I'm going to pay you 25, 26 times earnings for this thing, you'd be a happy seller. So that would be a strike that you'd be happy to sell, right? Just on a fundamental basis. The The other thing is that you're more likely to go into spreads if you're trading debit spreads rather than outrights when options premiums are higher. That's the case here. Options premiums in ADP are significantly higher than they've been over the last 2 years. The average implied volatility for a 3-month option, which happens to be the options I was looking at, but you can look at whichever ones you want, is about 20. Where's it trading right now? 33. So it's 50% higher. The options premiums are 50% higher than they have typically been. So I'm more likely to use a spread rather than an outright here. So I'm happy to sell up at around the 150 level. Maybe I'm not even going to be greedy. Maybe I don't think it's going to get to its price target. Maybe I think it's going to get just short of it. So I'll say, you know what, I'll do the 130, 145. By the way, notice that seems to be what this guy who traded the 1x2 today might also have been thinking. So that's the first thing. The second thing goes to the probabilities. And there's 2 probabilities you need to consider. Most of the time when I hear people talk about probabilities on this, they'll use 2 sets of probabilities, and they're not the same. But one of them is the probability that the stock is at a certain price at a certain future point in time, right? So if I buy an at-the-money call, that's a 50 delta option. At-the-money options are almost about 50 delta. There could be some, idiosyncratic things related to everything from dividends to hard-to-borrow conditions that could change that. But in normal conditions, let's just say an at-the-money option is a 50 delta option. And people will say that the chances that option is in the money is roughly back of the napkin equivalent to its delta. So if I buy a 50 delta call, I sell a 30 delta call against it to put on my debit spread, there's a 50% chance that it's going to be above that lower strike by expiration, and only a 30% chance it's going to be above my higher strike. Okay, so that's one set of probabilities you can think of. The other is, what is the probability that this is going to be in the money at any point between now and expiration? Well, this is a very different question, right? Because you don't have to, once you put on a debit spread, you don't have to hold it to expiration. And actually, there's a very good chance that if you do, you're not going to want to, because the maximum value of a debit spread is realized under a very specific set of circumstances, which is that the stock went in your chosen direction, that it got to or above the strike of the option that you sold, and that you felt that there was no risk, had it done so at some intervening point between now and then, that it might reverse. And that's very rarely the case. If you buy a debit spread and you pay 30% of its value, and you quickly double your money, so now it's worth 60% of its maximum value. Let's say you make even a little bit more. Say it's worth 80%. That wouldn't be uncommon, right? So you buy a call spread, you spend 30% of the difference. So you pay $1.50 change or whatever for a $5 call spread. Now the stock shoots up, everything's going your way. And now that call spread's worth $4. Do you hold on to that if it's got 45 days to go until expiration? Most people aren't going to want to. Time's on your side, but the risk-reward relationship has now changed dramatically, right? Because now you are risking 4 to make 1. Before you were maybe risking $1.50, $1.60 with the hopes of making $3 or something like that. So, I would focus on, when you put these things on initially, you can look at the delta as a rough proxy for the probability that the stock gets to a certain level on the expiration date. But generally speaking, you probably are going to be adjusting your debit spreads before then. And also just to free up capital, you're probably going to have found better opportunities.
Yeah, and I think to answer that question, we get a lot of questions about probability. We get a lot of questions about the Greeks. It's good to understand a lot of these terms or concepts. But however, OptionsPlay does a lot of the work for you. And we do it because we don't really want to calculate the Greeks. And, when we used to calculate the Greeks, there were more back of the envelope calculations than real calculations. And that's part of the reason why we created OptionsPlay, was because we were sick of doing back of the envelope calculations to figure out what our P&L might be in the future. Our P&L simulator is really designed to give you exactly what your expected profit and loss is at any time, any target or date, so that you can quickly see what your expected profit or loss is before you get into a trade. And we calculate probabilities of success on our platforms for you so that you don't have to do any of these calculations manually, even though some of you might want to or learn how to do so. But when you're actually trying to place a trade, sometimes it's just a little easier to have a calculator that's doing it all for you. So that's all the time that we have for questions for the pre-selected questions. If anyone has any follow-up questions, please type them into the chat window and Q&A window. I know we've gone quite a bit over our normal time slot. However, there's still a lot of you here, so we're here to answer as many questions as we have time for. So if you have any additional questions, please type them into the chat window or the Q&A window, and we'll try to answer as many questions as we have time for. There was a question earlier before, and the question was, would you buy a strangle going into the FOMC announcement on an ETF like SPX or SPY or QQQ? Any thoughts on that?
No.
Okay.
Yeah, no, I wouldn't do that. Couple of reasons for it that I wouldn't. For one thing, the options market is not the only market that has an opinion about what's going on, right? So, and there's two far bigger ones actually that have been sort of expressing, the consensus view when you take all of the opinions that investors have about what could happen, what will happen. The rates market, the bond market, and I'm not just talking about the treasury market, but when you take a look at risk premium in the form of credit spreads, when you take a look at what's going on in equities, people have been making their bets on this, and assets have been getting repriced, and at the same time, the uncertainty that could have for the markets has been baked into options premiums. I mean, right now, if you take a look at the price of a straddle, let's call it a 1 month straddle in the S&P, is essentially double what it was 90 days ago, right? So it's saying that the market, the movement over the ensuing 30 days is likely going to be double the amount that everyone thought it might move 90 days ago. Well, is that the right number? Is it the wrong number? I don't know the answer to that, but I know that if I bought that straddle or strangle, a lot has to happen for that trade to work out. And one of the principal reasons is that as soon as the event takes place, some of that uncertainty is going to come out of the market. So for those who said Powell wouldn't, they're going to get their answer. For those who said he would, they're going to get their answer. And to the degree that they were placing bets either for or against that, they're going to have their answer, and they may want to unwind them, and premium is likely to get sucked out. Is it possible that the market takes something out of left field and we get a sharper move on that than the market's anticipating? Yeah, it's possible, but it's a lower probability bet in circumstances like this. Really efficient markets. The S&P is a very efficient market. Rates are a very efficient market. Equities, price in a lot of information. To me, it's a little bit of a coin toss buying a straddle into an event like this. And I kind of like to have the odds a little bit more on my side than just flipping a coin.
Yeah, I couldn't agree more. I mean, on an individual basis, sure, there might be the possibility that you get a big move on the FOMC. As you can see, a 1 month straddle on the Qs is about $1,000, which means the Qs have to move down below 148 or above 169 just to break even on that trade. Not even talking about profitable, which is a pretty big move. And, you might make money on this one trade this one time, but long term, this is not a strategy that I think is very profitable in the long run when you buy these straddles going into these types of events because of how elevated the option premiums are. There's a question here, Oren saying, can you get into a market neutral strategy with a single name and sector ETF option strategy? Not actually sure what the rationale behind that trade is.
Market neutral. Well, first of all, the trades that we were talking about just prior, where, for example, you're buying longer dated call options and coming up with, you were calling it a poor man's covered call strategy. I would call it a smart man's covered call strategy, maybe. Because, just because you can buy the underlying asset doesn't necessarily mean that you want to. But I would point out that is a more market neutral strategy than simply buying equities. It is also a slightly more agnostic strategy than a covered call. So a covered call position is a modestly bullish strategy. But the key and operative part of that is that it is it is still a bullish strategy. And the reason it's bullish is because you are taking, dollar for dollar risk to the downside on your long equity positions if the market declines. When you go into calendar spreads, which will pay you in a market that's trending sideways or going up slightly, that is more neutral than a buy right, and it is more neutral than buying stocks, and it is more neutral than buying calls. Buying puts, I will say, is just an outright sharply bearish strategy because we've done a lot of research on this, and it's rare that you even get a coin toss bet on a long put. Puts are generally trading with what we call a volatility risk premium. What that means is that it's not a fair money bet to buy a put. It's actually going to be, there's excess demand to buy insurance to the downside. And so the expected value of those puts is actually less than what you pay. In the same way that the expected value of your car insurance is less than what you pay for it. There is demand to buy and not as much demand to sell car insurance. You're also obligated in many places to own it. And the people who sell it expect to make a profit. So you can buy, and they also have operating expenses. You combine all of those things, and the expected value is less than the premium you pay. And that is true for puts by and large. It is also generally true for calls on the indices. It is less true on a single stock basis. And the reason for that, of course, is because individual single names have a lot of idiosyncratic characteristics. And so it's harder to characterize generally whether it makes sense to buy calls or buy puts and so on based on broad market research and then honing in on an individual stock. But the short answer is that it is, calendar spreads are a relatively neutral strategy. And if you're, almost everybody has some marginally net long market bias. We invest for the future. We expect the economy to grow. And we expect the value of the major indices to grow, and they do. And they will do that because the economy grows, and they will also do that because they have survivorship bias. The S&P is comprised of, essentially the best 500 publicly traded equities. So even if the economy grows at a modest pace, the losers are going to drop out, and new winners will emerge and will be put in. So you expect the S&P 10, 20, 30 years hence to be higher than it is today.
Absolutely. So, Michael, I think we're going to end with one last question. This is completely off topic, but, do you fly into New York each week to be on Options Action?
Not every week, but most of them. Let's see. So I've been doing that show now for, I think our 10th anniversary is coming up in January. I've missed very few shows, and I'm usually in New York when I do them. So yeah, I mean, most of the time I do. However, happily I can report that I'm not flying to New York this week. I will be doing the show remotely from CNBC's One Market Bureau in San Francisco, and I will be doing it from San Francisco next week as well. But technically, I'm obligated to show up 36 Fridays a year in New York, and we spend usually 6 to 8 weeks on the East Coast in the summer anyway. So I fly the difference, if you can think about that. So I probably fly about 30 weeks a year.
Well, thank you so much for spending the time with us, Michael. This has been very, very helpful, and I hope everyone here that's been on the webinar had many of their questions answered, and we certainly went through a lot of different things here today, covered a lot of different topics. So that's why we do have this webinar recorded, and we will be sending it out to everyone along with the slides that I had shown you guys earlier. Michael, I want to thank you again for taking the time out this afternoon. It's been, I think everyone has found this extremely insightful. And I certainly want to thank you for taking the time, 2 hours, to sit down with our users and answering all of our questions.
It's my pleasure. You know, my wife once said, she said, I think there's no sound sweeter to you than that of your own voice. And so I don't mind talking about these topics. They interest me greatly, and I like talking about them. You know, the one thing I would leave everybody with, and it's just something that I've often thought about just as a sort of general market comment, and that is that I've always felt that equity investors look up, they're generally optimistic, and options traders tend to be more skeptical, and credit investors, because they have a limited amount of upside, generally speaking, and take more downside risk, are the ones that look for cracks in the ice. So if you're considering whether the marketplace for risk assets is a dangerous one or not, monitor the credit markets, monitor credit spreads, and also look at the general level of indebtedness. Because as I look at the economy, I don't know whether equities are going to be higher or lower tomorrow or next week. But what I do know is that levels of indebtedness have risen along with equity prices as a part of this bull market. And that's both corporate, it is personal, I think, and it is probably more shockingly government debt related. And that's something that people need to keep their eye on. And it's the thing that, if anything, keeps me up. It's not my positions, but that does sometimes. And I hope you guys all have a Merry Christmas. Happy New Year.
Thank you so much. Thank you, everyone. And I hope you guys have a great afternoon. I'll see you guys on Thursday on our regular scheduled webinar. Have a great evening.